Explore exactly what it takes to become a successful day trader and the power of consistency from the minds of the trading's elite. This is the Beyond the PDT podcast. Here are your hosts, Bryce, Tuohey, and Matthew Monaco.
Welcome back, traders. This is episode 20 of the Beyond the PDT podcast. I'm one of your hosts, Matthew Monaco, and in this episode, we interview Patrick McKay, who is one of the guys who runs OTCmethod.com and also helped develop OTCRE.com, which is a great scanner for OTC stocks. I know we've had a lot of OTC traders on the podcast recently, but in this episode, there's a lot of great advice on just overall trading, some tips for beginners, the best things to avoid. So even if you're not familiar with the OTC market, I highly recommend you listen to it and listen to the advice and the descriptions that Patrick gives, especially around volume and what you really should be looking for volume on a stock based on your account size. He also talks about a calculation he calls the turnover rate, and I'll let him explain that in this episode. Now, before we get started, I would just like to mention one more time, we are doing a sweet giveaway with Benzinga Pro right now. To sign up, simply visit beyondthepdt.com/giveaway, where one grand prize winner will win a 3-month subscription to Benzinga Pro. The second and third place winners will win some sweet Beyond the PDT merchandise, which include a hat and a t-shirt for the second and third place winners. Now, if you haven't heard about Benzinga Pro, it's a great software focused on alerting you on news on a stock. You know, if you've ever been in a stock and an offering hits, they will be one of the first platforms to alert you to this news. They have some sweet keyword searches and some custom filters you can apply to really look at specific stocks on your watch list or just the overall market in general. So again, if you want to sign up for this giveaway, it's completely free to sign up. Go to beyondthepdt.com/giveaway. One more thing before we start this episode. This will be our last episode of August because of some vacation and timing conflicts Bryce and I have the rest of this month. We will pick this up once again starting in September. So the giveaway winner will be announced in our blog post recap of this episode, which will come out in about 1 week from the launch of this episode. So without any further delays, let's jump into the episode with Patrick. Yeah, we used to record these things together, but then Bryce ditched me in like early May.
So. Yeah, and it has been that long, hasn't it? It's been like 3 months now.
Pretty close. That's wild.
Yeah, it's crazy.
Well,
it'll be nice.
A few episodes of the podcast. I liked it a lot.
Thank you. That's awesome. Great to hear.
Very nice. Yeah.
Yeah, it's pretty crazy because we're just college kids, right? So we were just struggling traders, and we were like, we want to like talk to the good traders, successful ones. So then we just started the podcast and as a hobby, and we didn't start with anyone crazy, and then as time goes on, people hear about it. We've had some really cool guests on, so we're excited to have you. This is gonna be cool.
Awesome. Well, I hope it's helpful. I mean, I trade all the things, but I find OTC to be the best, cleanest trading. So I do stick with it, but I'm overall about bigger picture trading principles, as opposed to just being all about like, oh, here's the hottest sub penny and stuff like that. So yeah, I'm looking forward to discussing it for sure.
Cool. And that just gave me some cool questions because I guess we'll find out a little bit more about you. But Matt tells me again you're primarily OTC. Actually, first of all, like where are you located? Where are you?
I live in Calgary, Canada, actually.
Okay, I heard a little bit of a Canadian accent there.
Yeah, I live up here, and I always have. And, I started off, are we recording now? Or
yeah. I think this is a good way to start it. Yeah.
Yeah, for sure. So, yeah, I started off about 10 years ago. I was trading Canadian markets only and focused on the Toronto Stock Exchange and then the TSXV, which is the venture exchange, which is kind of like what you would think of as OTC in the United States. And so trading, illiquid securities was not completely out of my realm of understanding. Things may not get a lot of volume at all. There may be 10 minutes between trades, an hour between trades, so that's kind of where I got my start. And so when I finally got more interested in U.S. markets, I was into NASDAQ and New York Stock Exchange, but I really, really got a a kick out of OTC because it's like what I was used to doing, And so I focused on that, and I've been pretty much exclusively focused on it for about 3 years, unless there's something I absolutely love on the big board, on the NASDAQ or the NYSE.
Awesome. Okay, and so before you started trading in the Canadian market, even how did you really get into it? Were you working a job before that, or did you have an interest right away in the stock market?
Well, I started out, so my career was actually in consulting firms, and so I was on the human capital side, and so I would spend a lot of time deep inside of filings, looking at all the different employee compensation packages, restricted shares, performance shares, things like that. And then we would work with clients to build these packages and their vesting period and things like that. So executive compensation helped me get familiar with all that, and also was where I really cut my teeth on balance sheets and SEC filings and all those different things that go into making a good trader. And so for me, finally, I just decided, I know these companies in and out. I've been doing the consulting. I've been doing it at that point for 9 years already. And so I started remembering all the companies and started going, well, I know this is a high value company. We did work for them, a year ago. They've got no debt. Here's a good investment opportunity. So it just kind of came naturally. But the advantage I had was that familiarity with filings and balance sheets and share structure and things like that.
Gotcha. So you started out kind of more investing rather than day trading. Do you still kind of have that style, or like a swing trading, or are you more day trading focused nowadays?
I do all the things, you know what I mean? And I think, because a good swing trade, oftentimes if it's a strong enough thing, it starts off as a good day trade, and then so when you see that continuation, then you can say, and so I'll probably switch time frame. So if something is really on fire and I get a killer day trade out of it, well, okay, now I can switch it to, let's say, a 30-minute time frame and swing it on that. Or if there's huge value being created, I could switch that to a daily time frame. So I like to roll the day trades into swing trades depending on the level of value there is being created. So it really depends. I don't like to get too locked down by the types of trades they are.
Gotcha. So these companies that, you're swing trading or day trading, are they more like you were talking about, they have value based? Where I know the OTC market's famous for pump and dumps, and we've had some people on who long them, some people on who short them. Are these kind of pump and dumps, or are they like you're looking for legitimate, real companies that are trading on the OTC market?
Not really. I mean, and I think when you look at even companies on the NASDAQ and the New York Stock Exchange, they can be real and have been going straight down for 5 years. You know what I mean? So what is real? So in the case of OTC, like you'll have tickers that are long defunct, and and I put together what was it was a lot of people needed structure for trading the OTC. Like how do I know if it's real, quote unquote real? How do I know if I'm getting roped into a pump and dump on a completely defunct security? How do I know what is real? So, real is a tough term, because is a company that's just making CBD chews real? They may have a CBD chew in the basement somewhere. Does that mean it's real? You know what I mean? So what we did is I created a step system for creating a structure to identify as to whether or not something's at least a real catalyst. So if something on the OTC that has been long defunct before is suddenly getting a lot of volume, here's how you can check. And so it's a checklist and a structure that I put together that I use every single time I look at an OTC security to see as to whether or not something is really happening. B, if I'm early or late. And see if the market is reacting to this catalyst in real time, or have people been buying it ahead of time knowing what's coming. And so so I created it on a flow chart. So each one of those steps, if it fails, like, these OTC securities, all of their material changes happen on the Secretary of State website, right? So if I go to the Secretary of State website and they're inactive, then I don't look at the ticker again. And then if they are active, I'll go to the filings and the news and see if there's something new that would be driving this. And if there is, then I've passed that level. If not, I need to ask why all of a sudden there's volume. And then from there, I can move to the next step of seeing if it's quote unquote front loaded. People have bought a bunch of it, anticipating a catalyst. And if in fact it is not, then I move to a share structure calculation. And I think this is where a lot of new traders struggle, is with share structure. You need to understand the floating shares to understand if there's even upside for you within it. And so I created a calculation called turnover, which is essentially the current price per share multiplied by the amount of floating shares that are out there. So, for instance, if you really are first and you've found an interesting catalyst, and that turnover number is, let's say, $20,000, that would mean it would technically only take $20,000 to move the stock 100%, flip that float completely. And now, let's say I'm chasing. I calculated again. Well, now it's $40,000. But I know that X type of catalyst can drive $1 million a day in volume. That turnover calculation allows me to still continue to see upside. And so that's how and so I made a video, I want to say a year and a half ago, I just decided to make a video about my penny stock steps. And people were really excited and interested in it because they'd never thought of, making a turnover calculation or always checking the Secretary of State website. And so there are ways to protect yourself from pump and dump on the OTC. So it's bigger than what's real. It's what I can really see upside on and what's actually happening.
So from my understanding, then a lot of your trading is pretty fundamental based, or very maybe if not all fundamental based. Does this strategy, I don't know if you call it a strategy or not, but would this checklist work on the NASDAQ market?
Absolutely, I use it every day, and so one of the games I like to play with people that are part of my website is up or down. And it sounds simple enough, but really, when you're looking at anything that you're trading on the NASDAQ or the New York Stock Exchange or whatever, when in doubt, you need to zoom out on a chart. And so if I put something on a daily chart, like, I was looking through FinViz today, and I scroll it way out. I scroll it out a year, and it's only been going straight down for that year. Already my understanding of the length of time that I want to be in that trade is pretty clear, because everyone that's bought it prior to me for the past year is a loser. So why would I be on this past the end of the day? Why would I be interested in it past tomorrow, unless there was an absolutely smashing catalyst? And from there, if you're looking at, like, if you were to use the FinViz screener, for example, you can look at the security and see the floating shares. So, basically, let's say there's a ticker and there are 100 million floating shares. That means between you and I, retail traders, there's 100 million to go around. And I'm jumping in on a ticker that only has 2 million in volume on the day and no catalyst and no reason that it's getting volume. The probability of my actually finding success on that day trade is so slim because there is an unlimited supply of shares. So why would the price go up?
No, yeah, I totally understand what you're saying there. That's all I was going to say.
So you're looking for something with low floating shares with a good catalyst, and using that to calculate the volume needed to make the price go up to wherever you might be looking for.
Absolutely. And it doesn't necessarily have to be low, but I think with enough experience, you can begin to understand, okay, this has 50 million floating and it's at $5 a share, which would take a lot of dollar volume to turn it over. But if it's a massive catalyst like a reverse merger or an FDA approval or something like that, then I can realistically begin to think, in time, they could actually begin to churn through these shares. So I don't necessarily feel it's a hindrance, but there needs to be something to drive the buying to chew through it, or else, what would make today, just because it hit my scanner, what would make today some magic day that it got volume, the day that I'm going to see upside when it's gone straight down for 2 years? Like, why? And I think for a lot of traders, that my biggest advice to them would be to stop scanning for volume. If you're looking for a day trade, stop scanning for volume. You need to scan for price action. Because let's say I just ran the FinViz screener here, and I decided I sort them by any ticker under $10 a share with the most volume. And if you look at the daily chart on almost every single one of those, they're going straight down. So is volume leading to upside, or is volume just dilutive volume?
And that was actually kind of going to be my next question is, I'm assuming with these stocks that you're trading, especially, you're looking through the filings and everything. You need to make sure that this company isn't just trying to get out of their positions, burn cash. You're looking for an actual reason for it to go up.
Well, I am, and that's the thing, and it's you need to know, like any ticker anywhere on earth on any exchange, the only reason they're publicly traded is to dilute shares and raise capital, right? So I can't be afraid of dilution, but you need to understand how to see it on a chart. So, like for instance, if I look at a ticker, like let's say, what's that one that CEI, for instance, right? So like there's one that goes straight down, does a reverse split, goes straight down again. And if you look at your chart on the daily, you can actually draw a supply and demand curve for downward diluted charts and their respective volume. So like I can see that price per share going straight down on the chart, and then I can see that huge puddle of volume at the bottom. And so if I actually draw a supply and demand curve on it, I can put the demand curve way up with that huge amount of rising volume, and then strike the supply curve, the supply curve straight up with that huge amount of rising volume, and then the demand curve straight down with that falling price, because they're unloading an unlimited amount of shares into the market, diluting them and causing the price to fall. So if your supply and demand curve is one where the demand is falling and you can see the supply increasing massively, there's just no upside there.
Yeah, gotcha. Is the dilution and stuff, is that part of your turnover calculation, or is that kind of separate?
It's separate, you know what I mean? And so the thing is that the turnover calculation may look good today, but if they're actively diluting heavily, it may not ultimately be valid. And then so you can go one step further with your calculations. So as we know, a company has an authorized shares. Like let's say I split up Beyond the PDT podcast into 10 shares, right? And then I have 5 shares outstanding. So you've handed 5 shares out to someone that lent you money. And that person who has those 5 shares has sold 2 into the market. The floating shares that you and I as retail can trade today is 2. Now, there's 3 more hanging above it, though, that this person has not sold into the market yet. Therefore, if I still have 3 hanging above my 2, my turnover calculation is based on the 2. But if I still have 3 waiting to be dumped, outstanding shares, then I can see the potential for dilution of an additional 3 shares. Now, if it's 5 outstanding and 5 floating, now I don't have to worry about dilution though. So I can go hard right now because that's fully diluted for the time being until you guys hand out 5 more shares to someone that lent you money.
Gotcha. I like that explanation. Bryce, you look like you have a question.
No. I'm thinking it over. It's just cool. I also think it's cool. Matt, we just went public is what's being said right now.
Yeah.
I think it's a lot to think about. It's cool though. And it seems kind of simple, but it's not something I think about every trade. And it's something maybe I should start thinking about a little bit more every trade is the share structure.
You should. And I think, people are always chasing volume. This has volume. That has volume. How much volume do you really need to make a day trade? Right? So let's say you had $2,000 to make your day trade. And this ticker that no one's talking about, but has been going straight up, has done, 300,000 in volume at $3 per share. So that's done 900,000 in volume on the day, in cash volume, dollar volume. And you only want to trade $2,000. Why, and it's been going up and it's moving and it's got a great, 8K or news or whatever. Why is it that you won't trade it? Because it doesn't have a ton of volume? It doesn't make any sense. Like, how much liquidity do you really need? If you're going to trade with $100,000, then maybe 900,000 on the day in dollar volume is not enough. But if you're trading with $2,000 or $5,000, that's more than enough. And you can make great money on tickers that people aren't talking about. And I think that's lost on a lot of people because, our natural inclination as a new trader is to go to chat rooms, hear what people are talking about, what's the hottest thing right now. And, any stock that you're hearing about a lot, it's programmed for you to hear it. Just like if you're hearing about the hottest movie, or if you're hearing about the hottest consumer product. I mean, there's billions of dollars at stake. And chances are the ones that you hear about the most are the ones that are getting dumped on the hardest.
Gotcha. Yeah, I like that a lot. So I want to talk more just about your story and how you kind of got to where you are now. So you were a consultant and then you kind of jumped into the stocks as you explained earlier. I know you're in Canada, so you don't have to deal with the PDT, but if you did you start below the PDT or did you start, above it?
Well below the PDT. Very, very low below the PDT. I had very little to work with. It was one of these things where I needed to find a way to find the biggest amount of upside. And so I think my account to begin with was, it was interesting. I mean, to begin with, it was about a $10,000 account. I just got super into OTC and I blew it out down to about $600. Destroyed it and, started really good. And I wasn't going to, I'm not telling my wife what I did, right? There's no way I'm telling her. So what am I going to do? So I started really focusing because whatever I'm doing right now, whatever anyone's talking about is biting me directly in the ass. So what isn't adding up here? And what wasn't adding up is all the other pieces of the steps, the filings, the SOS activity, the share structure, all that. And so I was able to finally turn that around and get that 600 to about 30,000 in about a year. And that's when I started picking up a bit of a following because people, like I did it pretty publicly, and people started getting interested in why, you're doing things I've never heard of. You're trading things I have never heard of until it's way too late. How can I get involved? And that's when we started, our website, otcmethod.com, to help people learn more about the fundamentals of OTC and the overall fundamentals of trading. And so that was how I kind of got my following, because it happened so quickly on the way back up. Just focusing on the steps, that, now For me to actually make a trade, I have to be extremely compelled. I don't feel like it.
So, out of curiosity, what were the exact changes, what were the big changes you made that helped you get there? If you could go through a few, because I'm sure there are people that have gotten in this situation before, and maybe they're stuck down there.
The number one big change I made, like I said, is I stopped scanning for volume. Plain and simple. I needed to go back to basics, and I needed to understand. And so what I decided to do is I just set it. I had no limit to how much volume I needed. One volume was fine. And I took the time to look at every single thing that's moving and understand why. Okay, so this is done 100% today, but it's actually done in a liquid way, like it's done it with a couple $100,000 in dollar volume, let's say. And so therefore now I'm going to backtrack and understand why it's moved. So, okay, in this case, it was an 8K explaining a reverse merger, good catalyst, check. Next. So I moved through before I started making trades again, I moved through every single thing that was moving on these markets and understanding what pushed it, and then trying to get into a place where I could jump on those things early enough. And that was really the thing. But I think the biggest thing for all, because I see these people, they just go, well, this is moving. You see it all the time, right? CEI moving. No, it's moved down. It only moves down. So why is it moving? And is it moving in a way that's sustainable? And it's the why for me that helped me get to a place where I could take a trade and leave the room. And if you're entering a trade where you can't go eat a sandwich or take a tinkle, you're in the wrong trade, pal.
So will you ever take a trade based on technicals then? Like, say stock's breaking out. Will you take that trade, or do you need a fundamental reason to hop in any trade?
So what I get into doing is I look at past big runners. You know what I mean? So like, let's say something made a huge run on a catalyst of some sort, even if it's a couple months ago. And then what I do is I will take it again, because eventually, and especially if they're not diluting heavily, those shares are going to get locked up in people's accounts, right? So that now all of a sudden the supply is getting smaller and smaller and smaller and smaller. And as the demand increases, it'll really begin to break out. So I'll pick up a breakout if I know why it has moved. A random breakout to me, even if that move happened months ago, that's fine. At least I know that it's breaking out based on something. But it's those random breakouts people pick up, where they pick something up on its scanner and it's moving, and then they take it, they buy it, and they turn around and it's back to flat. 9 times out of 10, what's happened is they tried to make this breakout trade, and then everyone else who was doing it with them found something that was really happening and went to it. And so I mean, for me, if you want to make a day trade, you got to know why it's moving, especially if you zoom out and see it's only going straight down. Like, there better be a damn compelling reason for me to buy it. And even if it's news or whatever, that's fine. There's got to be something behind it.
Yeah, understandable. And so kind of building on that, how long do you, I'd say on average, how long do you look into or research, whether it be the filings or whatever you're looking for per stock, before you decide to get in?
I should be able to run through my step system on each ticker in under 3 minutes. So the goal is to, like for instance, like let's say you've got a reverse merger 8K, right? Which is the number one catalyst, in all the stock markets. And so you look at that 8K and you see reverse merger, material definitive agreement. Boom. That's great. Here's a company that's not the existing company. What do I do now? How do I know if it's a good one? Well, the only thing that kills a reverse merger is a reverse split with it. If there's no reverse split as part of that merger deal, it's fire. So what do? I get that 8K out. Okay, I hear it's a reverse merger. Control F on the keyboard, look for the word split. If I don't see the word split, it's go time. So you put processes in place to allow you to quickly look, or like with the SOS activity, there's really only 5 statuses they have. So if I see a certain status, so you should become so good with it that as your scanner is looking at things that are actually moving, you should be able to break down in about 3 seconds. Okay, this is moving a bit. I'm looking, daily chart straight down, no news, no filing, next. Okay, this is moving. I'm looking, daily chart is actually going up and it is breaking out. But there's no news, there's no filing. But here's something that it's going in the right direction. So if I did want to trade the breakout on it, at least I know that ultimately, even if I took it too high, there's a better probability of me still getting out green, even if I got to wait a day or two. Because the stock's trend is upward instead of downward. And that gets me to what I'm talking about with these people trading volume all the time. It's, like if you catch a bad entry on something that's breaking out that's only been going down, it's still going down. So maybe you need to flip what you think of as a breakout you want to trade, and maybe it is on something that's overall on an upward trend. Because at least you have a fighting chance if you screw it up.
Yeah. So assuming you got all the fundamentals in place, how do you then trade these stocks, right? Because the technicals have to come in at some point for what point you're buying, right? What point you're risking off of. How do you go about that?
Well, on the super thinly traded OTC securities, for instance, you know what I mean? Like my goal is to get 100% right away. I want to be able to get half out at 100%, and I know that I'm good enough and able to be early enough with the way I break them down that I don't feel that that's a crazy goal. And then if I can get out my initial out, half of it out at 100% gain, and I'm just on the house, then I'll flip how I trade those shares. So now what I'm doing is I'm trading those shares on a 30-minute MACD to squeeze the most out of those. And then in the coming days, when that resets, or if it's so powerful, in fact, that it's something I can trade on the daily, then I'm going to trade that on the daily MACD chart. So I create the strategy as I go, depending on how hot it gets. And so that's, and with the big board, like if I'm looking at some of these tickers, like let's say you're looking at one that has been only going down and it has some hot news. I always like to imagine on a chart where the bag holders live. Okay. So like if I bought something at 32 and it's breaking out on news or whatever, and I look back on the daily chart and I see a huge puddle of volume with a candle that tops out at 40, chances are that the first pile of bag holders I got to get through is at 40. Right? And then if I go back further, I see another big volume candle, and it's at 50. Then the next level of bag holders is at 50. So I'll try and get to the 40 with a creative side. I don't just make it 40 because everyone else is selling at 40. So I'll sell at 391. See if it comes back. See if it gets sold back down by bag holders. If it inevitably will, but then if it bounces again and bounces through that 4, now I'm shooting for 5 because I see all the bag holders sitting on the chart in that puddle of volume in the days or months prior. I know where they live. And then from there, if that gets sold off and bounces through the 5, and I'm not seeing any giant piles of volume on a downward ticker prior to that, that's what blue skies looks like. That's when they say blue, that's blue skies, right? Like there's no one left to resist you. People always talk about what's the support, what's the resistance. Resistance is created by bag holders, not magical lines. So if you clear off where all the bag holders largely are, now I can get very aggressive. And so that's a little bit about how I think about charts and price targets and things like that.
Yeah, that's awesome. I mean, that's just something that I think a lot of people don't fully understand, right? Because you can just draw a line anywhere, but if there's no volume, then, you know, that resistance isn't a huge, heavy resistance level unless it traded, you know, millions and millions of shares on that day and a ton of people got bagged.
Right. And you can look back at these old ones and see exactly where bag holders live. That's what resistance is. So that's how I like to think about it. And then if you're able to break through all those levels, then you've really, it's time to get very aggressive. And that's how I like to think about price targets and how much I'm going to take, because every situation is so different. I mean, I wish there were hard and fast rules for these things.
Yeah, definitely. You mentioned the MACD. So I'm curious how you personally use that to, as you said, you know, squeeze the most out of the trade.
Sure. I mean, so, you know, like I have, an indicator that I've been working on for a while that, you know, I'm not quite ready to put out there, but I think for a lot of traders, you know, they need to simplify, because these trades, I tell you what, they're so crazy with the amount of indicators. How do you even know what you're looking at? It's bonkers. And so for me, I would only use MACD. That's my only indicator is MACD volume and then Heiken Ashi candles. And so, you know, if you're looking at something, let's say that you're trying to, you're looking for a couple day trade or something like that, I would probably trade that on the 30 MACD. And then I would look for, the MACD itself to enter the histogram below, and then as it travels through the histogram, I'm looking to hold on to it to see how high it'll take me as it goes through and above. And then that cross where the MACD or the short line crosses the signal line may not necessarily be a sell. So I need to give that some time. At that point, I would need to give that 3 candles. So the candle that which it crossed, and then 2 more fully developed candles so I don't get shook out. And chances are it's going to happen one way or another after 3. And then I'll make my decision there.
I like that. Brian Lee, who was our last episode 19, mentioned that a lot too, because you mentioned people using a ton of indicators, but there's also the other side of it where people have been told the whole time just to not use any indicators. And I mean, there's definitely a place for it, because you can add a little more, systematic approach to your trading. So it's not fully based on discretion. And what he's been working on, based on my conversations with him, is just he's testing indicators, looking for indicators, just something to improve, his entries, his exit. And it might not work every time, but if you can just add a little more systematic approach and just, have a reason to be in the trade or a reason to get out of the trade instead of you just feeling like it should get in or out. I mean, it's definitely something that can help you out huge.
That's the thing, because if I know, okay, this is a hot catalyst, this is bringing in dollar volume, this is bringing in price action, then I can begin to make a plan. It's when you're getting in things that lack catalyst that you can't plan for anything. You know what I mean? Or value's a catalyst too. Like if they have reduced their debt and all sorts of things. There was one I traded not too long ago on the big board, and I'll try and track it down, but they had basically eliminated their debt and gone revenue positive. You know what I mean? And so for me, that was something I was able to say, okay, I'm going to try this on the daily candles, and so the MACD gives me something to just work with, and keep an eye on, and if the volume's regular enough, then that's really all I need.
I think one thing you mentioned that's kind of important too is you said you wait for 2 candles to fully develop after you're looking for it. So many people, I think, try to just play like the indicator is going to be a magic symbol for them, like enter right now. It's, from what I've seen personally, it's learning how to react from an indicator that you've worked with and see where it goes from there.
Absolutely right. I mean, that's the thing. And you got to be prepared to, like, just because you got a signal to let's say get in, you got to be prepared to burn it off, because sometimes it just doesn't happen, like, and I know a lot of traders get this attitude, well, I'm in the stock now, so it's time to go up. I'm afraid it doesn't work that way. I certainly still feel that way sometimes, and it's just not how it goes. So you got to be prepared to cut it too, and not rely on the indicator overly. But you do have to give yourself some time not to get shook out. And I found that the 3 candle rule helps. That first cross is your first. 2 more after that, fully developed, whether you're trading on the 30, the daily, or the 5. And the point I would make to anyone day trading anything is don't trade it on the 1 minute. Seriously, your hair will fall out trying to do that. You go bonkers. 5 is where is if you want a day trade, it's 5.
Oh man, I remember the days of trading on 1 minute candles, and Matt always yelled at me.
It was like playing a video game or something. It was insanity when I tried.
It's more than a video game, man. That's just so much stress added. That's all I've got to say.
Incredible.
But no, one thing I wanted to kind of build on that you just started talking about is how do you manage a loss? How do you manage your risk? How do you manage when you need to cut a loss, get out of a trade?
I just, another piece of advice, and I don't know why I guess I'm full of advice today, but you invited me on, so I'll continue. Is stop averaging down. You got to stop. Like, really, it's you're already in a hole. You know what I mean? And the more you average down, and then you look at the things people are averaging down on that only go down because they got into it because it's in a chat room and it had volume, this. And then so they're averaging down, moving, and they're averaging down on something that's going straight down. You're just digging a deeper and deeper hole. So, if your entry was poor and you feel that there's no way out, like you just got to eat it. But averaging down to me is the greatest way to blow an account or end up perma-baggy. You know what I mean? And hope that something will happen. And the most part, with the type of securities that are volatile enough for people to day trade, the end game is a reverse split, which is total wipeout. So averaging down in those cases is really not a good scene.
So now what about for people who maybe take a starter size very small? Are you kind of against doing that? And then they take their starter size, it goes down and maybe hits another price target they're looking for. What would you say about that, I guess?
That's what I call a half and half. So in the moment, like let's say I have $1,000 that I want to trade. And I feel like I really need this. And the only way you can know if you really need it is with experience. You know what I mean? And let's say I feel I really need it. And I'm worried it's a bit high. I'll hit it with 500 of my 1,000. And if it just continues exponentially from there, great. I've made a great trade with 500. And this situation where people go, well, every time I buy it, it goes down. Well, how about this? Have your other half ready for that moment when it goes down and hit it with the other half. So I'll take an instant average correction in the moment, but a long-term average down in a bag is a no-no. But I call that a half and half. And I see because a lot of people say, I really like it. I think this is a real runner, but I'm worried it's too high. It's too high. Take a half and half. And if you're really worried it's too high, you could switch to a 1 minute chart and see where all the people got in. Because is 100% up 100% up if only 5 people purchased it at 2 and everyone else bought it at 4? It's not, is it? The play starts at 4. So in that case, I may go full because, if everyone enters at 4, then, I'm more comfortable going full instead of a half and half. But if most are at 2 and I'm betting on continuation and it's at 4, I'll do a half and then see what happens.
That's a riddle right there for you. You blew Bryce's mind. Look at him over there.
Yeah, no. I feel like these conversations, they're just like, I feel like there's stuff I should know, and then people say, and it's like, wow, that makes a lot of sense. But no, I mean, for people, I think it's great advice. I think it's awesome advice.
Half and half.
I like it.
All right,
Yeah.
I'm glad.
Yeah, and the half and half too. I mean, it's just you need to just plan your trades, basically, and that's, you don't know that when you're just starting out, obviously. But if you just have a dedicated plan before you get into a trade, I mean, your risk at that point. You just have to be disciplined enough to follow your plan. I mean, that's trading, right there.
You do, and sometimes your plan sucks, and you got to just admit it sucks and cut it. I mean, and the sooner you can just admit it, and I mean, it's so hard for me because new traders, well, I don't take a loss. I take a lot of losses in search for the right thing because I need liquidity to be able to take something that I know is truly hot. And getting weighed down in bags, like, not only is bad for your mind because you're staring at all those bags all the time instead of finding out what's new, what's hot, but it's also bad for your account in the sense, because when you actually find something that is very high quality, you barely have any money to invest in it. You know what I mean? So you need to be ruthless with these bags and know when you're beat. And it happened. You have to have the modesty to admit that you are.
All right. So, I want to put you in a position you've never been before because you're from Canada. But assuming you were below the PDT and you were trading with, $2,000 or $5,000, a starter size account for some of these people, how would you, with the experience you have now, go about growing that account to make it beyond the PDT?
Well, here's what I would do first. I would pick up my phone. I would call my broker and tell them to switch it to a cash account. Because with a cash account in the United States, I can sell when I want. Okay, so that's the problem with PDT. And this blew my mind, is that people were trading under PDT rule, and they'd get to a point with the amount of day trades they have where they can't sell. And that's crazy to me. And I said that this cannot be. And but I knew other people in the U.S. that could, and I said, what's the difference? They said, well, you can have a margin account that's under 25,000, which is most of our default accounts in the U.S. But if you call your broker and say, switch me to a cash account, then you can buy and sell whenever you want, as long as you're cognizant of cash clearing times. So if I had $2,000, I would split it into 4 piles of $500. And then what I could do is I could try a couple of trades in a day, and maybe one of them turns into a nice swinger, maybe the other's a failure, and I could sell them both instantly. Then the next day, I would take the 2 other piles of 500 and try those trades and see if they work out. And if they work out, great, then I'd sell them. Now, the cash clearance time, I believe, in the U.S. is T+2. So by Wednesday, my cash from Monday has hopefully cleared, or Thursday at the least. But you need to get to a place where you can actually make trades and don't get forced to catch a bag. And that's the thing about PDT that I did. You don't have to use PDT. You can trade with a cash account and buy and sell whenever you want, as long as you're cognizant of the clearance times. And then what I do is maybe, those 4 piles of 500, I like one, I made a good trade on one, and I'm waiting for the gains from that trade to clear. Maybe I'd take 500 out of my bank account, make a trade on that gap day with it, and then take the gains from the prior one once it clears and drop it into my bank account. Cycle it out. So you can, with the correct type of bankroll management, not even have to be on PDT.
Yeah.
That would be my advice.
That's perfect right there. And I mean, I think a lot of people just don't know that, because personally, for me, I mean, I traded for basically a full year under PDT, and then I was like, what am I doing? I could just have a cash account and I wouldn't even have to deal with this or think about it. And it was just a no-brainer. I just had no idea that was a thing.
No, and
cash account is the way to go.
Yeah, we have over 300 users at OTC Method, and some of them would be like, I missed out because of my PDT. Like, I could have sold for 100%, and I'm like, well, you could have. And so that's my advice. Like, in terms of the other advice, if you're trying to get above the PDT in terms of your bank account size or your trading account size, you better be able to tell me exactly why something is running. And if your answer is, moving, volume, if those are your answers, or a guy on Twitter said it was good, if those are your answers, that's the wrong answer. I need to know why. I need to understand why and be empathetic enough to imagine people that don't trade every day want to buy it too, because they see it as something genuinely exciting. If I can't imagine a baby in a diaper on the street, if I can't elevator pitch this stock to that baby on the street and get him to slap it with lemonade stand cash, and he doesn't understand it, it's probably not that hot.
That might have been like the best explanation. Yeah.
Yeah. That was funny. That's something else. Yeah. So, I mean, this has been an awesome conversation.
Thank you.
Super.
Yeah. No, seriously.
Going to be a great episode. My kind of just finishing last question is, what's next for you personally? Whether it's, you get something personal you're working on, you're trading, what do you got going on the next 6 to 12 months?
For me, it's just, this website, we just launched it, OTC Method, about a year ago. About a year ago, but officially launched the website. I've been doing the course for some time. We officially launched the website a couple months ago. And then our ongoing project that, my business partner and good friend Dario Vaccaro, OTCRE.com, which was something that he mostly built. I just kind of busted his balls on Skype while he worked on it, but I had some ideas, and it was a affordable alternative for OTC traders to equity feed. So we would provide all the news, all the filings, all the actions, and then the Secretary of State activities, all together in one package for one website for a fraction of the cost of other services. So he got that up and running, and then I started focusing on this. And those two websites are my focus 100% of the time. And obviously, people who are with me in my service, any questions they have, whatever, I'm 100% at their disposal. So that's my life now, and I love it.
It's awesome, man. Good for you.
Thank you.
Love to hear it. Yeah, love to hear it.
I mean, you have any last words before we officially wrap this up?
No, I mean, I would say, though, if you are trading the NASDAQ and the New York Stock Exchange, and you are nervous about trying the OTC, it's actually not that scary. You just got to close your ears, and stop hearing, and then start really focusing on the catalyst. And I think I've built a structure that allows people to find a way to be successful in it. In addition to other trading. But the last words are, if I don't know why, I'm not trading it, period.
Perfect.
That's it.
Love it.
Yeah, great ending right there, man. Thank you for coming on. Yeah, I really
My
appreciate
pleasure.
it. Hello again, everyone. It's Matt, and thanks for listening to the entire episode with Patrick. I hope you guys enjoyed it, and as usual, if you have any questions, comments, or concerns for us, please hit us up at beyondthepdt.com. And while you're there, make sure you sign up for the giveaway, which is at beyondthepdt.com/giveaway. It's free to sign up. And again, one winner will get 3 months to Benzinga Pro. It's really a sweet giveaway, and we are very grateful for the help they're giving us on this giveaway. Second and third place winners will get some sweet Beyond the PDT merchandise. So it's a win-win. So go sign up. Make sure you tell your friends about it. And we'll catch you guys early September for episode 21 of the Beyond the PDT podcast.